Good afternoon, everyone, and thank you for joining and tuning in with us today. I am Eric Guidi, Managing Director of CFA Society San Francisco. It is my pleasure to welcome you to our webinar today, Alternative Assets Diversification with Asset-Based Lending and Farmland Timberland. Our speakers today are Eric Kong, Principal and Portfolio Manager at Marathon Asset Management, LLC, Alex Katerick, CPA, Head of the High Net Worth Strategy Team, Private Markets at Manulife, and Jonathan Glass, Director of Business Development at Marathon. A quick item to note before we start, you will be muted for this event, so we encourage you to type your questions into the Q&A box. We will monitor the questions closely and endeavor to have as many answered as possible. This event will also be recorded and shared in a few days. I'd now like to introduce our moderator, Jane Delfendahl, CFA, Investment Director at CalPERS. Jane manages real estate investments primarily in the international sector. Prior to CalPERS, she worked as a financial controller for waste management in Italy. Ms. Delfendahl earned her MA, her MA from the John Hopkins University School of Advanced International Studies and a BS from US Berkeley. We are also pleased to be partnering with CFA Society Sacramento today, where Jane serves as the Society's programming chair. Now at this time, I'd like to turn it over to Jane. Thank you.
Okay, hello, welcome everybody. Welcome to our quite timely discussion. I think we woke up last year to a watershed moment where interest rates reversed course from a downward trajectory to an upward one. On top of that, we're now questioning bank stability, and cocktail conversation has moved to which banks are safe to keep your money in. A few drivers playing out in the institutional market are increased return opportunities within fixed income, but also investors are suffering from the denominator effect. So we have a great panel today, and we want to hear what these groups are offering investors these days. So I'm going to start with Ed, and Ed, if you could tell a little bit about yourself. And then I'm going to launch into my first question, which is, how has your portfolio construction changed since the interest rate shift?
Sure, absolutely. Thank you, Jane. So I've been at Marathon for 17 plus years. I am a portfolio manager. I oversee both our public and private asset-based lending strategies. I sit on the firm's global investment committee as well as executive committee, and was part of the management team that ran the U.S. Treasury's PPIP fund back during the Great Financial Crisis, when we were helping to stabilize the U.S. housing market at the time. So we're no strangers to sort of valuation or revaluations of large asset classes and regime shifts. Now, I think, Jane, to your question, the way we think about the interest rate shift, we try to make it very organic. I think that the different factors you have to think about when dealing with a regime shift in interest rates are the competitive environment, sort of the forward economic scenario, the different sort of recessionary scenarios that you're thinking about going forward, and also just obviously straight up pricing, right? Base rates, credit spreads. Now, I think the key impact here, we try to keep it very organic when we think about our portfolio construction. And the key is, obviously, you're getting a higher interest rate. You have the ability to earn a higher rate, right? But the problem is that you have to protect principal on the other side. And so it's not, it's a zero-sum game when you're getting a higher interest rate on a piece of debt, right? Your borrower is actually having to service a higher cost of debt. And so the way we think about sort of, that environment is we're looking for sectors where there's less competition, where we can basically name our pricing terms. And so, sort of where we've been focused in the last 6 months to a year, we're focused on sectors where basically we can push pricing power, right? So sectors where we can, effectively increase rents for the higher inflationary environment, the higher interest rate environment. That would include sectors like transportation, narrow body planes, commercial aircraft, limited service hotels on the commercial real estate side, garden style multifamily. And we're sort of really focused on sort of, those type of assets. Really well covered residential mortgages is another place where we're focused. I think in certain parts of commercial real estate, those are going to be challenged fundamentally, like office. And then, for example, the consumer side of the picture, we've been pretty, sort of cautious on. But I do think that over time, as sort of the interest rate regime sort of sets in, the repricing happens, and we're going to have that ability to basically leg into those other sectors going forward. So,
Do
so
you
throughout
mix
the
all
term
these
thing.
sectors in one vehicle, or how do you do that? Or how do you
Yeah,
judge one from the other, and what's an example of your hold period on these? Are they very trading intensive?
yeah. So we typically are originating called 3 to 5 year loans. And so we do mix these strategies together into one vehicle that covers, all aspects of, sort of asset-based lending that includes commercial, residential real estate, healthcare, asset-based lending, transportation assets, sort of aircraft on triple net lease, consumer loans and auto loans. And that's why we can make it very organic, right? So we can say, hey, for example, on a consumer loan, we want to price in a higher base rate, a higher SOFR curve. We want to price in higher credit spreads, and we want to assume that the unemployment rate is going to increase by 2.5% within the next 12 to 18 months. And so when we basically put that into our, sort of our pricing matrix, we push that out. And if you could imagine, that's our price, right? We're naming our price or naming our rate. And then is the market there or not? If the market is not there, then we pull back. And that's how that affects our asset allocation sort of in a very organic fashion. And if the market is there, then we can lean into it. So that's just
How often are you turning over these investments, or?
I think that probably, it's not. It's
months or not days, but months, or
I think it happens
most of
over
them 3 years, or?
I think it can change sort of quarter to quarter. Particularly last year, it was changing probably month to month. I think now we're probably into sort of a quarter framework, maybe half year to half year framework. But it doesn't, which we try to be not too reactionary about it as well.
Okay, so maybe one more question for you while I still have you here. So how does ABS fit into a portfolio, and how does it compare to corporate credit?
I might actually turn that over to my
Jane.
partner, Glass, to answer that one.
Yeah, hey Jane, and thanks so much for hosting.
Okay.
Yeah.
You want to tell something about yourself, and then you can get the question?
Yeah, I mean, you had quite the introduction from Eric with announcing all of your accolades and education. I pale in comparison, but I'm managing director at Marathon Asset Management. Have been working with Ed for about 5 years now, overseeing our relationships and sort of business development efforts within the private credit space. And to your question, the private credit markets have really, quickly evolved into a multifaceted opportunity. And if you look at the traditional definition of private credit, it's about $1.3 trillion, which is roughly the same size as the US high yield or leveraged loan market. And that's up from about 400 billion 10 years ago. So you're seeing a dramatic amount of growth, and the taxonomy of what those strategies are can really range. Obviously, the base has historically been middle market direct lending, which is about 500 billion of the $1.5 trillion. You, of course, have real estate, you have specialty finance, you have mezzanine, you have distress and special sits, but you also have this large spectrum of asset-based specialty finance strategies, which by some estimates is about $5 trillion, set to grow to $7 trillion by 2025. And so take a step back. This is really, within private credit, you have this diverse mosaic of strategies. It's really a painter's palette. It is a paradox of choice, but there really is an interesting opportunity to pair existing corporate middle market direct lending, real estate, and distress when there's a true distressed environment and infrastructure with asset-based and especially finance strategies that are quite complementary. And at the end of the day, what allocators are looking to do is take advantage of different risk and borrower profiles, because they've seen that their existing exposures have been largely homogenous and too focused on corporates. And Alex will talk about this in a little bit as well, I'm sure, but you're getting corporate exposure through middle market lending, through private equity, through high yield, through loans. And there's so many other strategies out there to take advantage of to really create what we like to call a core plus portfolio, where you're taking advantage of higher levels of contractual return and exploiting a fuller opportunity set.
What kind of returns are you targeting in that strategy overall?
Well,
it's a lot of different strategies.
So I think asset-based lending is one of the few areas of the market where there's an illiquidity premium, a flexibility premium, and a spread premium, because we're largely not focused, or not largely, we are not, focused on sponsor-backed transactions as how we source. And, we're not part of a syndicate generally. So there's a spread premium, and historically it's been about 400 basis points in excess of core middle market lending, is what I would say.
So if I were going to invest in your vehicle, what kind of return am I thinking about here? 9?
Well, I don't think on the
Maybe you
CFA side I'm allowed to speak about
or a
funds,
range, can you give me?
but yeah,
next above
we're
corporate?
expecting sort of around 8 to 11% is
Okay.
the range in terms of sort of where we're focusing. Depending on sort of where you are in a market cycle, there's the opportunity to outperform.
Okay. So maybe you can tell us, Jonathan, how have the priorities of investors shifted? Because you're spending more time talking to investors, right?
Yeah, absolutely. So it's a really good question. I think there's been a lot of talk and chatter about, what got us here isn't necessarily where 60-40, historically that's over the last 10 years, the average return's about 8%. I think with correlations, cross asset classes starting to really, break down or rise, I think their clients are really rethinking portfolio construction. And a way to really think about that is, what is important to them, right? And I think the private markets are one area where you can get a spread to, the liquid markets, where you can achieve high absolute returns, low correlation, a hedge against inflation, a reliable and contractual income stream, and a way to sort of, reduce portfolio volatility. So there is definitely a focus on income maximization to protect the downside, to maximize returns. And I think to do so, clients are increasingly leaning into diversification and illiquidity premiums within the private credit market, because it's a beautiful time today to be in credit, probably the most attractive in the last 15 to 20 years, where you've gone from being sort of a price taker to a price maker, and you can lend less and earn more. So we're keeping it simple and focusing on sort of high quality borrowers, quality assets that we can underwrite to. And there's certain strategies that you can really benefit from to, maximize income and protect the downside.
Okay. So let's move on to Alex and we'll get back to you guys. Alex, do you want to say a little bit about yourself, and then we'll talk about opportunities that you're presenting to investors?
Yeah, thanks, Jane. So I work for the private markets team at Manulife Investment Management, and my role is to really face off with our private wealth management channel. So speaking with advisors, investors, in terms of how to allocate to the strategies that our private markets group runs. And so, was there a question, or was I just introducing myself?
So yeah, both. So the question is, what opportunities are you presenting to investors these days?
Oh yeah, of course. So where we're focused.
You're a large
right now,
insurance company, right?
Well, Manulife is an insurance company, but as you may or may not be surprised, insurance companies run large private markets groups, right? So if you look at where we've allocated, dollars on behalf of our general account, it's across private equity, private credit, and real assets. And what we've been focused on with investors, really over the past year or two, when I say investors, I mean, investors outside of our insurance assets, has really been in the timber and ag space. So, Manulife is actually is the largest owner of Timberland globally, and the second largest owner of Farmland globally. And we are of the view that as investors are looking for alternative asset classes, a lot of folks think of real estate when they think of hard assets. And we think that timber and ag is a great step beyond that. And if you think of the similarities, if you buy a building, a building throws off cash flow through yield, but you can improve a building, but it's a long life asset that has value and it appreciates over time. And timber and ag, I think of that similarly. You can buy a timber lot, or you can buy a piece of farmland, and it's going to generate that yield for you. It's going to have some embedded appreciation, but you can improve upon that. The way that you manage it, the way that you take care of that asset, the way that you think of best use for that asset, you can actually, change the income stream or the value of that property. So for folks that are thinking about hard assets that are looking to differentiate their exposure, we like to think, if you're invested in real estate, that, timber and ag is a good next step.
So what of your general fund, for example, what range of allocation might you have to timber?
So for our general account, again, this is maybe not, for the audience that we're here speaking to now, that I think are more, individual investors. When we think of our general account, where we're coming at this as an institutional investor, and if you think of our insurance assets, we have these long dated liabilities, which again is why the timber and ag asset class, it's a long life asset. So it's under 10%. But it's still a meaningful allocation for an insurance company and for institutional investors.
So are investors viewing timber as kind of an ESG play these days, or?
I think our institutional investors certainly do, and timber by its very nature is a sequester of carbon. So right off the very back, you've got the nature of the asset. Makes it very ESG friendly. And we at Manulife are focused on sustainability, and it's one of the core tenets of the way that we manage our company and the way that we invest. So it's very much in line with the way that we think about things. If you look at both the timber and the farmland side, we have, third-party firms that have assessed our ability to manage these asset classes sustainably, and have received rewards for that. So, from an ESG and sustainability standpoint, we do think it's very, very important. Institutional investors are looking for ESG solutions, and it really differs geographically. I think it's more important to maybe some European and in some cases Asian investors that investments are ESG centric. When I look at the private wealth channel and the individuals that we work with, it's less important to them. But then again, it's also, geographic, certain folks, tend to have an interest in ESG investing in different parts of this country. So it's not something we necessarily are advertising our capabilities around, but it is implicit in what we do, both on the timber and the ag side.
Now, have you guys reset your kind of targeted returns given the new inflation paradigm?
Yeah, so what we do find in the timber and ag space is it typically does well in periods of sharp inflation. And if you look at the returns for both the farm and the timber asset class in 2022, you had very good returns. Because we had this inflationary environment, typically what happens is in that first period of inflation, you're able to maintain your margin because you've got pricing power. That does erode over time. So I think in 2022, it was a great place to be invested in timber and in ag. I think if we have persistent inflation going forward, that gets trickier, right? Because your input costs are going up. You start to get pressure on the ability to pass along those price increases, and it does erode that margin. So long-term asset class returns, and if we look at it on a blended basis, so both the timber and the ag side, typically you're looking at 9 or 10% on a total return on a blended basis. And of that, 9 to 10%, maybe 3 to 4% of that comes in cash yield. In a low interest rate environment that we were in, 12, 18, 24 months ago, that was a great return profile. If that's our current return profile, I think it's a little less exciting. But again, solid year in 2022 in that inflationary environment. So we do view it as, people want to own this asset class for, the non-correlated returns that you get, diversification within the portfolio, and then that kind of steady eddy kind of 9 to 10% return that you're able to get.
Okay, thank you. So maybe back to Jonathan. Which departments, like of pension funds, deal with alternative products like yours? Is it fixed income or?
Yeah, I think pension funds have been growing their allocation of private credit across various segments. I think it really will depend on the size and the sophistication of their private credit program, but they may have a dedicated bucket for private credit, including but not limited to direct lending, asset-based finance, and opportunistic credit. So this allocation is found either in the income or the diversification bucket, and it's generally under the fixed income umbrella. And then there are some pension funds that split up investment grade from, other types of credit, with credit then being split into, liquid and illiquid.
How does it generally fit into, say, like a high net worth portfolio? Like invest, allocate what kind of percentage to this type of strategy?
Yeah, well, so that's changing, right? And that's the white space opportunity. The typical, high net worth individual has an allocation of, call it, between 5 and 7% into alternatives, right? And so that's why I think you're seeing folks sort of rethink that paradigm and really have and adopt an institutional style alt portfolio where you go from 60-40 to 40-30-30. And bonds can be 30%, and private credit could be 10, private real estate could be 10, infrastructure 10, private equity 15, and then you have the public equity portion at 25. And so it's really sort of adopting that that institutional style approach. And what's really interesting is 2022 was a really exciting year, because that was really the year when you reached parity, where individually managed assets and institutionally managed assets converged, and both at 35 trillion apiece. And so they want the same allocations, and that's why you've seen a lot of democratized structures being used and leveraged to create access to institutional strategies. And we're seeing that new strategies and funds pop up every single day to take advantage of that.
Okay, maybe a question for Ed. So which real estate sectors are you finding interesting for credit?
So
Maybe you
you're
can
asking
talk
sort of across the
maybe
board.
more detail about those opportunities.
Yeah. Would you be including residential in that question as well, or are you asking? Yeah. So I think right now we're focused on obviously valuation, revaluation, and I think the whole theme sort of as hopefully I communicated earlier is basically how do we get to the higher return but make sure at the same time we're still well covered, and we're basically making sure we adjust our covenants so that we're as well protected today in this higher inflationary environment versus kind of pre the rate regime change. So I think generally speaking, we're pretty constructive on parts of the residential real estate lending market. I think that there is some very good embedded value. I mean, there's almost $35 trillion, $31 trillion of untapped home equity in the U.S. housing market. $45 trillion. This is for sort of single family homes, condos, and so there's just an incredible amount of home equity that has not been tapped. Obviously, that relates to the great financial crisis. Lending regulations have been very tight. You're sort of seeing that now. The housing market is only down sort of 4% from the peak, and part of it is that you have this lock-in effect. And so the way we think about it, so returns, obviously, mortgage rates have just about doubled, but I think that generally speaking, the market is still pretty inefficient. So there's opportunities for us to invest in sort of seasoned mortgages at yields in the high single digits to sort of 10% area. And we're just focused on as much equity coverage as we can get. So preferably 30-35% equity. So we like the portions of the residential mortgage market. I think another theme that we're sort of really digging into is basically this concept of who are the real winners in this whole interest rate regime shift. And you're seeing a lot of discussion about the losers, right? And the banks, the big banks. But I think the U.S. consumer, anybody who's taken out a mortgage at 2.5%, 3%, those are the real winners, right? And so I think that there's a situation where, in some cases, you might look at sort of a borrower. You might say, okay, so it might be better to sort of extend an extra 10-15% behind that first mortgage that basically is locked in at 2.5%. And why is that? And by the way, this applies for commercial real estate too, because your overall debt service coverage is actually in the money. You're actually positive on your debt service coverage. Now, if you think about someone who's taking out a new mortgage or a new commercial real estate loan, if they're paying sort of 8-10% or 7-10% for that first mortgage, a lot of times they're actually underwater, right? I mean, cap rates are below that, generally speaking, in commercial real estate. So I think you might actually get into a better situation where you can, charge a very healthy rate of return, 10 double digits, 10-15% for that, sort of, that profile. And then the last thing I would just mention on commercial real estate, we're really, we've been super deliberate for the last several years. Again, we saw, kind of where the capital was flowing. So we have been focused basically on, again, those sort of property types where we feel like the rents can keep up with inflation. So limited service hotels, sort of self-storage, garden style multifamily away from the coast. And even in those sectors, I think generally speaking, we feel good about what we've done in the past few years because those values have been able to keep up mostly, but not completely.
Right.
There's still going to be revaluation.
What about CMBS and what about the office situation?
Yeah, no, I think the CMBS market, like if you think about, hey, I mean, if you think about conduit CMBS, which is basically, sort of the call it diversified, framework in CMBS, you're going to have some office, right? You're going to have 10, 15, 20% exposure to office. And that's a, sort of an example where, diversification works against you, right? And so I think there, there's been a pretty steep repricing, sort of at the triple B level, some of those bonds are, generally speaking down, 30, 40, 45 points. And so a lot has been priced.
Well, those conduit ones are like what percent office?
Yeah, so they can, kind of be, 15, 20%, 10, 15, 20%.
Yeah, sorry, I don't know that much about them, but that's
yeah. So there's going to be some exposure there. And so I think the good thing about that sector is you can underwrite loan by loan, right? And so that's something where I think the market has been pretty quick to reprice. I think there's eventually going to be a pretty good opportunity there in discounted securities, and so we're actually watching that very carefully.
How much of those office ones declined? I'm wondering if it's the same as like general office values out there.
Yeah, I think the bonds that have sold off, in that range, 30, 40, 50 points are being driven by that exposure to office.
Okay.
It's not, I mean, you're not going to.
What about office specific CMBS?
I think that's basically by appointment. That's position by position. So it's hard to say.
Okay.
Yeah, I mean, I think that, if you're on the coast, I think there was a question about, San Francisco, I mean, New York office. I mean, there's there are going to be some pretty hefty losses. So
yeah, there are a lot of
happen.
bad news articles coming out on that.
Yeah. But those bad news articles, you always have to go back and retrace the steps of the borrower and when they refinanced, how much money they took out, and then from there you can sort of think about, hey, if they're going to sell below their basis, how much have they already taken off the table? You always have to do that now, obviously. So some of these sponsors, these big real estate sponsors, are very shrewd about that. So.
Okay, so Jonathan, do you want to tell us any more about investor preferences or desire for basic wealth preservation?
Sure. I think the real key is sort of, with clients, I think it's reconciling, a liquid fixed income market where high yield is high yield again, and how to think, pairing that with, locking up capital in private credit structures. And I think that's, a continued debate. And I think that there really is an opportunity for both, or where, liquid markets could be a bridge to, interesting private credit opportunities. So I think, net, it's just a great time, whether it's timber, ag, or it's various areas of the private credit market, to really, take advantage of higher base rates, wider spreads, that's contributing to the much higher sort of nominal yields that you're seeing. So credit in general is just really attractive. People are trying to sort of reconcile, okay, how do I, should I think about the next distress cycle? And if I'm doing that, when should I get the dry powder ready? That's sort of been much more of a slow moving train. But, Jane, you mentioned it in your opening, remarks. The denominator effect is real. And, the markets are really, really competitive. I think at the end of the day, you have to think about managers and platforms that have been market and cycle tested. I think that clients and maybe even some allocators have been conditioned to think the Fed's just going to come into the rescue. And so you've seen, obviously, inflation is a hot, topic right now. and sort of a rate complex that's gotten pretty complacent, as I could sort of probably, weigh in on. But, people are looking for income-oriented strategies. And if they want to sort of take a bet on opportunistic or potentially distressed investing, they want to make sure that they're getting compensated for that risk. And I think that they will. I think there's a really good opportunity to do both. So I think, again, with my opening remarks, you have this paradox of choice. You have multiple levels of complexity. It's thinking about how to take advantage and build your portfolio to tactically take advantage of certain opportunities while also generating meaningful income, throughout a market cycle, whether it be benign or more volatile.
So I'm not sure how many vehicles we're talking about at Marathon, but you guys probably offer different risk levels. Is that correct?
Absolutely. Yeah, we're global credit managers. So we're involved in the high yield markets, the loan markets, the securitized credit markets, emerging markets, and then, corporate distressed and asset-based specialty finance and real estate. And so we're looking at the market through both. Yeah, it's a lot to do, but I think it's important to be successful in the market is just to not myopically, look at the market through just a public or private lens, because the public markets really do inform how we think about pricing and asset allocation on the private side as well.
Okay, so we have a question. Do either of you offer investment access through SMAs at Charles Schwab?
Alex, we've dominated this, so why don't you jump in and
Alex,
we'll answer after you do.
Well, I hate to, that's a no. It's not something that we're set up to do.
So that means somebody has their money at Schwab and they say, hey, will you manage it? Is that what they mean?
No, I think it's more of a custody related question, maybe, where, if a client is custodying at Schwab, there is a vehicle sponsored by John Hancock that is custody at Schwab.
Oh, okay. All right.
And sorry, we do have, and again, the idea is not to come and speak about specific funds, but we do work with various registered investment independent advisors that do have access to some Manulife timber and ag products, and I guess they might be on a Schwab platform. So it is possible that folks could get access to some of the things that we do.
So Alex, do you offer mostly pre-specified vehicles? Investors?
Yeah, so in the majority of what we do is geared for institutional investors. I had mentioned that my role is to help find ways to bring some of those solutions to private wealth investors, so individual investors that work with advisors. So we do have funds that are available in the RIA space, that again, not that we're trying to talk about specific products here, but we do have those solutions.
So what other parts of the RIA space, like diversified real estate vehicles, or?
No, it's more specific to the timber and ag side.
Oh, okay, so not real estate.
No.
Okay. Let's see. Maybe Jonathan, you want to talk about more how investors can learn more about your opportunities? Or I feel like it's a pretty complex space, and I don't know if everybody on here, I hope they all know more than me about access and what exactly I'd be getting into, but.
Yeah, and I think, just to echo Alex, I think we want to try to avoid, in today's discussion, talking about funds. I think the bottom line is, for both Alex at Manulife and, for Marathon, we have a variety of solutions. We have a Marathon website and a Manulife website you can go to. And, for specific partnerships, I won't mention funds, but for partnerships, we partner with John Hancock on a specific partnership to express this asset-based, specialty finance solution that we think is complementary to middle market direct lending. And so the John Hancock website would have a lot of information around that. But yeah, hopefully we can, just share, Alex's email address and mine. And, I know that we would both love to just sort of engage with the audience and maybe talk off of a recorded line around different solutions and sort of where we're most constructive across the credit markets and how to express those views.
Okay. I've got another question for Ed. So what kind of tools do you use to analyze investments?
So I think that it depends on
This one's off script, so.
Yeah, it's all script. Happy to answer it. So we use a combination of sort of quantitative tools and also just sort of old school asset valuation underwriting. I think that for example the DNA of our firm is basically focus on asset valuation. So if we're looking at an aircraft investment, and we have the fellow who runs that strategy is a trained pilot. We have engine specialists, so we want to make sure we understand the metal very deeply. The same goes for sort of commercial real estate. I think and then I think what we do a lot is we also sort of bring in sort of the quantitative tools as well. It depends on the granularity of the asset. So for example, on the residential consumer loan side, we were basically running a lot of different paths scenarios, and we're pricing every single loan. It could be 1,000 loans, it could be 10,000 loans. We're doing it all separately, and we'll sort of roll it up, by the pool. So, I think that the key to sort of underwriting, sort of analyzing in this particular environment is you have to be very flexible. For example, for our residential mortgage strategy, consumer loan strategies, we're literally running sort of unemployment rate scenarios from 3.5% to possibly 10%. I mean, that sounds crazy, but it's something that we feel like is important to stress. We're running home price scenarios down 5, 10, 15, even 20%. So, that's, we try to bookend, make sure that, we're covering as many scenarios as possible.
So you're doing lending to aircrafts or aircraft leasing, or?
We do both. I think recently we've been primarily focused on leasing. And part of the reason for that is just that, the competitive sort of capital flows and competitive environment has actually loosened up, or it's gotten less competitive in the last 2-3 years. Some of that relates to COVID, international travel, Russia-Ukraine issues. But we're actually looking at sort of really high quality, in demand, mission critical Airbus A320 assets, at 10 to 14% unlevered returns. And that is juxtapose that versus call it 6%, maybe 7% going into certainly going into COVID, and so we've more than doubled. And so I think there's certain sectors where the sort of the competitive environment allows you to take advantage. So.
What advice would you give to somebody interested in working in private credit?
I would say, try to focus on, get back to basics. And I would say that, focus on, sort of the underlying asset, focus on the underlying cash flows. And, this is something that John touched on, recently or a few minutes ago, which is that even when you're in private credit, private credit is a tool, right? It's a tool where, I think, why do you want to go private is, I think you want to have more control. For us, it means that we can get to the asset quicker. We can basically access the asset to increase our recoveries. But at the end of the day, you have to listen to the public markets too. I think when you're in privates, you can't completely ignore the public markets. And so, that's something that I think is a piece of advice I would give.
Okay, thank you. So Alex, has Manulife changed its strategy lately about asset allocation, or?
No, why would you ask that, Jane? What are you getting at there?
Just given the whole shift in the interest rate environment, have you
No,
noticed?
I mean, I think, so given the nature of the type of investing that we do on the private market side and the very long-term nature of our approach, I think we are sticking with it. I think as John said earlier, I think it's a good environment right now in the credit space. So we've been very active in terms of our credit team and putting capital to work. Our senior loans team put a record amount of dollars to work in 2022, and I think they'd be happy to do the same in 2023. So they're continuing.
Now you're a Canadian company, right? Are most of your investments here in the US or in Canada? Or how does
So,
that-
so Manulife is a Canadian headquartered, but as folks may or may not know, we also acquired John Hancock. So John Hancock is a US based organization. So we think of ourselves as a global investor and a manager of global assets. So if you look at the types of investments that we've made through our private markets team, a lot of it is US centric in terms of, we work with global private equity managers, but if you look at our credit business, it tends to be predominantly US focused. We do have a team that sits in Asia, so we are active in building out our investment capabilities there. But
So in
again,
Asia, you're doing loans or?
no, so one of the big things that we do as an investor is we actually invest into into third-party private equity managers. So we actually are invested in nearly 200 different sponsors. So that's our private equity program. So that's an active business
But
for
you're
us.
buying into the manager, like you buy 25%.
No, we're an LP investor into the funds
Oh, okay.
of a number of managers,
Oh, okay.
right? So upwards of 200. And I mentioned the Asia business because we're increasingly making allocations to, Asian managers. That's maybe a newer thing for us over the past few years.
So you see that as an attractive area?
I think that, the long-term trends of Asian growth and just economic activity throughout the region makes us positive in terms of trying to find opportunities to deploy capital there. And we do have, we do have insurance assets that come from Asian clients. So that's, part of the investment process as well, to be able to put that capital to work.
What about infrastructure investing?
So we do have a series of infrastructure funds that we manage for institutional investors. So that's something that we're active in across traditional infrastructure. So think, transmission lines and ships and ports, highways, toll roads and the like. But then additionally on the digital side, so towers and server farms, or what you will. So that's a very active, space for us. Again, it does align with, the nature of an institutional and, investor that is deploying capital for insurance purposes. So it aligns quite well. So we do actually have a large and capable infrastructure team.
Interesting. Okay, we had a question. It says in the ABF space, now is that ABF or ABS? I don't know. Considering the current economic environment and tightening underwriting guidelines, is there a focus purely on contracted revenue rather than uncontracted revenue? What are your credit committees more comfortable financing right now? And whoever wants to answer that.
I think, maybe just to echo Ed's points, I think what we're focused on within the asset-based finance space, I'm guessing that's ABF. We're focused on, really asset-rich, one example would be either asset-rich companies or, lending in asset-based situations. So yes, contractual cash flows is something that's really, really attractive right now. If you think about the rising rate environment, an inflationary environment, we can pass that through in the form of higher lease rates to our counterparties in the airline space. That also leads to higher residual values. And I think if you combine that with the supply, a COVID-induced supply chain that's been severely disrupted, that creates a valuation floor where, to take a new plane and bring, to deliver a new plane, it was 6 years before, now it's 7 or 8 years, and there's a 10,000 plane backlog. So, contractual cash flows are something that we're always very focused on, or it's lending to, asset-rich companies, healthcare companies that are developing therapeutics that might own their property, plant, equipment, might have other drugs in their pipeline, truly asset-rich companies. And I think the beauty of providing financing solutions in spaces like that is, private equity sponsors aren't going after it. They cannot be banked because these sometimes are revenue positive companies, but they aren't profitable, but they're very asset rich. And so you need expertise that could sort of, find a financing solution to lend against. And sometimes that comes in the form of hard or financial collateral that generates a lot of cash flow. So definitely focus on contractual cash flow.
Okay, thank you, Jonathan. So I think we're kind of getting at time. I want to thank all our participants. Ed, Eric, are you going to close out here?
I am. Thank you guys all for such an engaging conversation. We really appreciated your time today. We'd like, for further discussion and questions, sorry about the dog. We have provided contact information in the chat. I'd also like to thank Ed, Alex, Jonathan, and Jane for today's engaging conversation. And we'll see you again at another event. Thank you very much.
Thanks, you guys.
Thanks, folks.
Thank you very much.
Thanks, everyone.